insurance a little bit later on in this module. So what do we do with these dividends? Well, there are 7 dividend options available. Not all insurance companies offer the 7 dividends. In fact, not even all insurance companies offer participating whole life insurance. But if you do have a dividend, what are you going to do with it? Well, there are really 7 different things we can do with it. Sometimes we just give it back to the policy owner as cash or check. They just get the money back. Easy. Sometimes we leave it as a pool of savings. This is referred to in industry literature typically as dividends on deposit or dividends left on deposit. And those dividends on deposit, it's really like having a savings account attached to your whole life policy. Something to be wary of here, though, is that this is not a tax-exempt situation. You've taken those dividends, you've invested them outside of the policy. This is taxable. Any growth that happens here will result in a T5 being issued and taxes being paid, just like on a regular savings account at your bank. The other option we have, we can take that money and put it into an IVIC, an individual variable insurance contract. The IVIC or the segregated fund, and you'll learn about the IVIC or segregated fund a little bit later in this course. It's going to have some similar characteristics to that dividends on deposit. It's really an extra pool of investment now that we have associated with our whole life policy, but it's going to generate tax consequences just the same as a regular investment would. We could take those dividends and use them to acquire some term insurance. Using a feature called term additions. And with term additions, all we're going to do, pretty simple here, we have our whole life policy. Let's say a $100,000 whole life policy, participating of course, and it pays out a dividend from time to time. We're going to take that dividend and we're going to use it to buy, just like we looked at in an earlier video, we're going to use it to buy a 1-year non-renewable term insurance policy. At the end of the year, that 1-year non-renewable term insurance policy runs out. You might find that on a $100,000 par whole life policy, your dividend is enough to buy $150,000 of 1-year non-renewable term insurance. So for that period of time, if a death occurs, there will be a $250,000 death benefit associated with this policy. And then next year, you're of course hoping that your dividend will be paid again and it'll be used to buy another $150,000 non-renewable 1-year term insurance policy. And then maybe next year the same thing and the same thing. There is the risk though that a dividend gets missed. So what happens if we have a situation where there is no dividend paid? You have a year where there's no dividend. Well, most insurance companies actually offer an alternative here. They'll say, you know what, if you want to take the risk, we hope that you can buy that $150,000 policy every year. But we'll take the risk off your hands if you so choose. And the way that we'll do that is we'll say, you know what, instead of the $150,000, for example, and I don't know exactly what the numbers would be, it would depend on the age of the life insured and the mortality cost of the life insured, but whatever the numbers happen to work out to, maybe instead of $150,000 of coverage that's not certain, maybe we'll guarantee you $100,000 of coverage every year. We'll lock that in. So there is some flexibility here. The insurance companies don't want to pass on unnecessary risk to their insurance necessarily, and in order to help accomplish that, they might allow you to just lock in that amount of insurance. Of course, the insurance company knows that the dividend scale is pretty stable and that they're likely to be paying this out for a good long time. but it does take the risk out of the policy owner's hands. Then we could look at the next the next dividend option, and that next dividend option was very common in the 1970s and even into the 1980s, less so today. It's called special term editions. And with special term editions, what happens, we're going to do something a little bit similar to what we did here. You might recall from my discussion a few minutes ago that if you buy a $100,000 term whole life insurance policy, then it's always going to be a $100,000 death benefit. But at the same time, you are building this cash surrender value. Well, some people look at that and say, you know what, that's not really fair. If I die with $50,000 of cash surrender value, my death benefit's still only $100,000. I'm really not being rewarded for having built up that cash surrender value, or my beneficiaries are not being rewarded for my having built up that cash surrender value. So what about this? What if we could find a way to build this whole life policy such that at the point of death, your death benefit will be $100,000 plus the cash surrender value? Well, there is such an option available. And what we can do is we can take the dividends paid by this participating policy, and we're going to use that dividend to buy just a little 1-year non-renewable term insurance policy. So you buy a little 1-year policy here, a 1-year policy here, a 1-year policy here, a 1-year policy here. Again, you face this risk that if there's no dividend paid, there will be nothing available to purchase that term policy. But for the most part, that's not something that people really considered when they acquired this option, and they just ended up assuming that those dividends would be paid out consistently year after year. Some insurance companies would have guaranteed that even in the absence of a dividend. So you'd have this string of dividends paying out enough to buy a death benefit, a 1-year non-renewable term death benefit equal to your current cash surrender value. And if we think back to that basic structure of whole life insurance, this kind of works because your cash values are growing as that cost of insurance decreases, as you build up more value in the policy, which gives more opportunity for dividends to be paid out. So you typically do have a larger dividend year after year after year as you're committed to your whole life policy. And we're going to take that dividend, we're going to use it to buy that cash surrender value. If there happens to be any excess dividend, we're going to return that to the policy owner in the form of cash. Now, there is another dividend option that sees us purchase more life insurance, and maybe you've figured this out by now, that we've got 1, 2, 3 options that see us invest the money or give it back as cash. We have a further 3 options that are going to see us acquire more insurance.